Hello and welcome to Sustainability in Your Ear, the podcast conversation about accelerating the transition to a sustainable carbon neutral society. I'm your host, Mitch Ratcliffe. Thanks for joining in. This is the first episode of our 2024 season, and I hope you've had a relaxing holiday because 2024 is a pivotal year in history, and we'll be working to keep you connected to the emerging circular economy as the world continues to debate our path forward. Today, let's talk about how we can use our money to influence responsible, sustainable business practices. Over the past couple of years, ESG investing, that's environmental, social, and governance investing, which involves choosing stocks, ETFs, and bonds based on responsible environmental, social, and governance practices, has become a mainstream topic and, unfortunately, a political punching bag. Nevertheless, ESG's focus on the externalities that were long ignored by many business leaders has improved our insight into the future cost of today's actions. It turns out that knowing, for example, that a retail company that spews carbon emissions in its shipping today faces rising sea levels that will interrupt its supply chains and raise prices tomorrow. That's a solid base for identifying risky investments. 2023 was a tough year for ESG, even though more capital is flowing into ESG reporting companies. As of 2024, as inflation cools, it's expected that consumers will continue their migration to sustainable products and services, fueling higher returns for ESG-aligned stocks. Our guest today is Ben-Vivari. He is co-founder of Till Investors, which helps investors evaluate and invest in green and socially responsible funds. Ben contributed an article to Earth911, which we also published today. It's called How to Invest for a Healthy Planet. And it's a useful introduction to ESG investing that looks at how you, the individual investor, thinks about risk. He identified 3 fighting styles: avoiding, rewarding, and engaging companies based on their ESG disclosures. And I wanted to dig into those strategies in this conversation. But first, you can learn more about Till Investors at tillinvestors.com. Till is spelled with 2 L's, T-I-L-L, and there's no space, no dash, tillinvestors.com. Now let's get into the conversation. Welcome to the show, Ben. How you doing today?
I'm great. How are you?
I'm doing well. It's a interesting new year. 2024 is going to be quite the thing.
It will be. If 2023 was anything, 2024 will be more.
Indeed, and we have some major choices to make this year. So
Always, but especially this year. That's right.
And one of those choices is continuing to invest and deepen our sustainability as a society. And let's talk about that. But first, tell me, how did you end up co-founding Till Investors? What brought you to sustainability-oriented investing, and what have you been doing?
Sure, it's a great question. So I started out, I was very interested in this stuff way back when it was called corporate social responsibility. That was the big buzzword in like the mid 2000s. And on my career, I sort of, moved around quite a bit and ended up working in the investment industry, helping asset managers with their communications. And so, it's always a challenge to talk about what you're investing in and why it's the right investment and all of these things. But when this concept of ESG, so environmental, social, and governance investing came out, that was a real eye-opener for me. And I said, oh, this is something that I'm really interested in. And it's something that I can see my clients really struggling with. It's hard to talk about, well, here's why this is a good investment from an investment perspective. It's even harder to talk about, well, here's why this is a good investment from a sustainability perspective. And so, sorry, go ahead.
So how do you define and use ESG values in your work? What's your dictionary definition?
So my dictionary definition, this is just mine, everybody can have their own, right, is that ESG investing is investing in companies that are generating strong returns while peacefully coexisting with the world around them, right? So both of those points are equally important. It is an investment. Returns matter, right?
Mm-hmm.
But also peacefully coexisting with the world around you matters, right? So if you're generating returns while polluting in large amounts, that's not peacefully coexisting. Same thing with like poor supply chains with human rights abuses, or creating unsafe products, or setting up some ridiculously unfair compensation scheme for executives, right? All of those are not peacefully coexisting with the world around you. And The theory is, in the long term, those unhealthy practices are going to come back to bite these companies, right? And eventually they'll have to fix the pollution, or they'll have to stop doing the human rights abuses, or whatever it is, and that will end up affecting the company's bottom line in the long term. So it's really looking at sustainability as a driver of investment performance.
Now, peacefully is an interesting choice of words because we are in a transitional time. And of course, everything that we do, that we consume, make and consume, has an environmental impact. And I'm going to focus particularly on environmental impact in this question.
Yeah.
How do you quantify real peacefulness, to use your term, in terms of that impact? Does a company need to be 50% better, 75% better, before they qualify as an ESG compliant company for you?
So you might be disappointed in this answer, but there's a certain level of expectation leveling that you have to do here, right? Especially in an investment industry where everything is driven by data, right? X point X returns, Y, whatever profit and loss, right? There's a rush to create a number that might not be as meaningful as you want it to be. And so you have to sort of level set, right? You have to say, all right, I'm not going to be able to say that this company is 1.4% environmentally better than the other company, right?
Exactly.
Yeah, and you're going to have to be okay with that. Now, it might be that 20 years down the road, 40 years down the road, when the data gets better, the reporting gets better, the rules and regulations around how you're going to have companies need to report this stuff gets better, that we'll get to that point. But right now, you've got to be comfortable with the idea of we might just need to be looking big picture. We might have limited data. But that doesn't mean that we give up. It just means that we make the most educated decision that we can with the data available to us.
Well, you're really hitting on the reason I asked the question, because we all have a constellation of values, and
Yes.
we're going to do some trade-offs within, environmental and social and governance, for instance.
Yep.
But to your other point that you just made, we are getting better at measuring and understanding the impact of the things that we're doing. And ESG has become a real political whipping boy, because the practice is seen as including assessments of impacts that weren't included before, and therefore seem like a hassle or over-regulation. What's your response to an ESG critic when asked about, for instance, states that are banning the use of ESG data by their employee retirement funds because they consider it to be manipulating the market?
So realistically, this is an incredible self-own by these states, right? They are willfully misrepresenting what ESG is,
Yeah.
and they are costing themselves millions of dollars in the process in order to score a political point that isn't really a legitimate point in the first place, right? So what these states are mad at is that big asset managers like BlackRock are giving their investors the option to invest in ESG funds that give them, that do place higher weights and higher priorities on sustainability things. They are not forcing their customers into these options. They are giving them options, right?
Yeah.
And because of that, these states are saying, well, we are out on you guys entirely. But these are also, because they are the largest, they are the cheapest options for all these states. So now they're paying literally millions of more dollars in fees to these different funds just because they don't like that BlackRock or Vanguard or whoever it is giving consumers a choice. Right. I can debate with you the merits of whether or not ESG is a good investment option, and I'm happy to do that. But to be mad at a company for simply giving consumers a choice, I think is disingenuous.
It certainly flies in the face of free market economics, which we always hear about from the people who are primarily the critics of ESG. So
Rules for thee, not for me, right?
yeah. Well, and the other thing is that in a lot of situations, they believe those choices put them at a disadvantage, that their states, because of the other policies that are anti-environmental or anti-social, they put in place, are costing them money, and they simply want to avoid the impact of their decisions. It's quite the thing.
It is, and I understand and I empathize with states that generate a lot of fossil fuel income, right, and to rely on that for tax revenues and all of that, that they are going to be in a tough spot. But the reaction to that being a tough spot is not to be mad at companies giving consumers choice and costing yourself even more money by boycotting them.
So let's get into the kind of the nitty gritty of starting to do ESG investing as an individual. So
Yep.
let's say I've got a 401k and maybe I trade some stocks in a brokerage account. Do
Mhm.
I need to change a brokerage or are the options available to me? And I know that's kind of a dumb question, but that's where a lot of folks start.
That is not a dumb question. That is often where folks start, and folks aren't dumb, right? The answer is not necessarily. Your brokerage is the best place to start. It's the most logical place to start, right? Just about every mainstream brokerage at some point offers access to some sort of ESG fund. Some of them might have their own sustainability funds. Some might have others that are just on the list, right? And so start with your current brokerage. It is a pain to switch brokerages, right? And that's a real consideration here, right? A lot of people don't want to, spend that much time to go through all the heartache of switching brokerages. So start with where you are, see what the options are. If you find one that you like, great. If you don't, then yeah, maybe consider switching brokerages. But again, ease of movement is a real and important factor in terms of what how you choose a fund. The bigger challenge is that often brokerages are not they're not doing a great job of helping you compare funds'
Mhm.
sustainability characteristics. Right.
Right.
They have a nice table for you that will show you returns, that will show you how long the fund's been here, that will show you the Sharpe ratio and this and that and all the different metrics, right? But they don't have a good way of comparing the sustainability characteristics. And so you might have to do a little bit of extra legwork to learn those. Um, but that's not something that I would consider, something that couldn't be overcome.
Now, there are a lot of different asset classes, and picking amongst them is always challenging. Which ones do you recommend someone start with when moving into ESG? Is it best to focus on an individual company stock, an exchange traded fund because that collects various assets, or would you look at things like green bonds? Where would you begin your exploration?
So it depends on who you are, right? For most people, right? If we're talking about the average everyday investor, the safest and most logical place to go is to mutual funds and ETFs,
Mhm.
right? At some point, you reach an amount of money where it makes sense to diversify further, and you might want to go into bonds or things like that. But there are also, if you're saving for your retirement, many people choose a target date fund, right?
Mhm.
And those target date funds will shift between stocks and bonds depending on how close you are to retirement, right? There are now, they're very young, but they are starting to come onto the market, target date sustainability funds, right? That will do that work for you as well. But in general, for individuals, I always say mutual funds and ETFs are the way to go. They are good for diversification, right? But also because, in this world of ESG, things are always changing, right? This is a very young industry, I guess is the way you could put it. And so things are changing. And so making a decision about like a specific company, that might be a great decision now, but in a year, the data could be different, things can change. I like the idea of instead finding a fund manager who's going to be paying attention to these things for me and putting my trust in that fund manager rather than the individual company.
So, how would you identify which fund managers to trust with your money?
So a couple of things that I look for in particular. I look for funds that have a long track record, right? So there's a lot of new funds, but there are companies that have been at this for 25, 30 years, right? I look for funds that have a lot of AUM, assets under management, meaning that a lot of other people have chosen to invest with them, right? And then I will take a look at that fund and there's two questions that I ask, right? Because you want to make sure you're not getting into a fund that's greenwashing. You
Mhm.
say, do they say what they do, and do they do what they say, right? Is it very clear to you, looking at the fund literature, what their methodology is for deciding what is sustainable and what is not? And then when you look at the holdings and you look at what's in that fund, does that make sense? You say, oh, I can see why these five companies are the largest ones they have, because this is the methodology they told me about. And if
Sure.
you don't get either of those things, that's a big red flag, and I would move somewhere else.
So where would you do your research? As you said, there are a lot of new funds and a lot of new trends in ESG emerging all the time. Is there one, two, or three websites or magazines that you suggest people read to understand what's coming?
I think you're best off starting with your brokerage,
Mhm.
right? If they have some sort of a sustainability label or filter, right? Use that filter, and then look at those key financial metrics that they are good at showing you, right? Assets under management, returns over 10 years, right? Returns since inception. Use that as your initial filter, right? And then you got to go to the fund site to do that, do what they say what they do analysis,
Right.
right? If within your brokerage you don't find something that you like, I then you should look at other brokerages is really the best place to go.
You wouldn't go to a third party or editorially oriented site that provides stock commentary, or are there any of those that you could use as a benchmark against which you assess the fund companies?
So there is one group out there that I like a lot called As You Sow. And As You
Yeah.
Sow is sort of a shareholder advocacy group. And they have a great tool that you can find online called fossil free funds. And
Yep.
what you do is you go in there and you can type in the fund, right? And it will tell you how invested they are in fossil fuels, but they'll also tell you how invested they are in things like weapons or tobacco and a handful of other things, right? That's a good third party site for this sort of stuff. Um, but to get to a level where you're talking about where there's a third party that really dives into the different methodologies and things like that, the reality is that I haven't seen a great one yet, right? There is still legwork that has to be done. Now, what I will do is make a shameless plug for our book at Till Investors that we put out, Sustainable Investing and an ESG starter kit for everyday investors. In the back of that book, we detail about 15 or 20 of the larger fund managers who focus in this area. We tell you what their reputation is, what they're good at, some of their most popular funds. Um, if I was to recommend a third party, I would shamelessly recommend us as a nice third party to do that research.
Okay, then let me put you on the spot.
Go for it.
2023 was not a great year for ESG investments in the sense
Yep.
that a lot of money didn't flow to them. It flowed particularly to fossil fuels.
Yes.
Yet, Standard and Poor's says that their ESG indices still outperform the wider market, not by a whole lot, half a
Yep.
point to a little more than a half point. But
Mhm.
what's your take on where ESG investing is going to end 2024? Will we see more capital inflows? Will we see better performance, continuing better performance?
So those are two different questions, right? There's the inflows versus outflows and the performance question. So let's tackle the inflows and outflows first. So yes, there were outflows for ESG in 2023. That was largely a reaction of what happened in 2022, right? When fossil fuels did really, really well, right? But also, this was where there was a huge influx of money into ESG, and there needs to be a little bit of market correction, right? There needs to be a little bit of, okay, we're going to explode all these different fund options. People are going to go crazy for them. And then when they don't perform the way they want them to in the short term, because fossil fuels do well, they're going to move out. So that's what we saw in 2023. I think that in 2024, in terms of inflows and outflows, we're going to see a leveling off. I think that the back off has happened, And
Mhm.
now we're going to go to, and I don't use this word tongue in cheek, a more sustainable growth of sustainable inflows. I think that we had to zoom in. I think we had the market correction, and now we're going to slowly go back up in terms of inflows and outflows.
So some consolidation of the trend.
Correct. Yeah. In terms of performance, I can tell you that what's going to happen is that if fossil fuels go one way, ESG funds will go the other way, right? If fossil fuels have a banner year in 2024, it won't be great returns for ESG funds. And if fossil fuels do really poorly in 2024, in general, ESG funds will do pretty well. The one place where ESG funds are overweighted is often in technology stocks. They do very well on these scores and these rubrics. If those stocks do well, in general, ESG funds are going to do pretty well in 2024. But more importantly, you need to consider that when we talk about ESG investing is long-term investing, not what's it looking like in 2024, but what does it look like in 2034? What does it look
Right.
like in 2044, right? And so, it's hard to sort of live in it, but you need to keep in mind that you're playing the long-term game. And 2024 is going to happen, but the long-term thesis of eventually polluters are going to lose market share, are going to lose revenues, that theory is still in place, right? So that's what I think is going to happen in 2024, but that doesn't change what I think is going to happen over the next 10, 20, 30 years.
Well, this is a great place to take a break because I want to talk about the fighting styles you identified in the article you contributed. We're going to be right back after this commercials.
Excellent.
And now back to the conversation with the co-founder of Till Investors, Ben Vivari. Ben, you contributed an article to Earth911, How to Invest for a Healthy Planet, and you described three fighting styles for making sustainable investments: avoiding, rewarding, and engaging. So I want to talk about each of those. But how do these different fighting styles help someone orient themselves to their investments?
Yeah, so, as I talked about in the beginning, one of the things that we were doing is watching these asset managers try to explain their sustainability practices and really struggling to do so. And they've gotten better at it over the last couple of years, right? I mean, it was a new concept, but what we need to do is we need to help the readers who were trying to digest this information understand what they were seeing, understand what the asset managers are trying to tell them. And what we found is that the asset managers were really focusing on three different types of activities that we call fighting styles, right?
Mhm.
The first one is avoiding. That's the easiest one. It's saying, here's an industry type of company that I don't like. I'm not going to invest there, right? The next one is rewarding, or might be called, best in class investing, where you decide what you think makes a sustainable or a good company, and you are investing those companies that meet those characteristics. It's a little bit trickier because there's a lot of different ways to identify that and to consider that in lots of different metrics, but that's
Yeah.
one of the things that these funds do. And finally, there's engaging. And this is where these fund managers, these asset managers, are going to work with companies to actually encourage them to change their practices. And often sustainability is a big focus of that, right? It can be done, if you have enough money invested, like BlackRock owns 10, 15% of some of these big companies. Vanguard owns 5, 10% of them. When you own that much money in a company, the CEO is going to have to listen to you, right?
Sure.
So you can go and meet with them, you can talk with them, and then also you can do things like vote your proxies, vote your shareholder votes. So there's the engaging, there's the rewarding, and there's the avoiding. And those are the three activities that you as an individual should be looking for when you're evaluating a fund.
Well, let's look at several of these in a little more detail. Avoiding
Yep,
is essentially the divestment approach.
yep.
You don't put money into something that you don't want to see propagated in the world. Besides avoiding fossil fuels in one's portfolio, what other sectors should an ESG-oriented investor consider avoiding today?
Well, some of the most popular ones, and I mentioned that site, fossilfreefunds.org, they track these. Things like private prisons are a particularly popular one to divest from. There's also weapons manufacturers are often divested from, but there are some creative ones out there too. Like, for example, there's a vegan climate ETF that's out there that divests from companies that do animal testing or make products from animals. So, you can find some pretty interesting stuff down there, depending on what your real passion is.
That that's interesting when you put it that way. It sounds like the same kind of market fragmentation we're seeing now that we have the ability through digital technology to create communities like a
Yep.
vegan community that's large enough to have the impact that you're talking about. That also invites a lot of potential ideologically driven rather than investment driven rhetoric. How do you
Yes.
differentiate that when you're listening to organizations talk about what to avoid or what to engage with?
Well, I mean, you just always need to consider the source,
Mhm.
right? You need to consider their motivations and you need to consider your motivations, right? If you are one who is passionate a particular thing and that rhetoric really speaks to you, as long as you are acknowledging that it is rhetoric, right? And that is not necessarily investment talk, and you decide that that's where you want to put your money. I mean, you're where you invest is you're investing your values, right?
Yeah.
And there are some people out there who are going to say, rhetoric, schmeteric, I need to make sure that I'm saving for my retirement. And there are some people out there who are going to say, well, yeah, I want to save for my retirement, but I'm really passionate about this thing and I want to put my money towards that too. And the important thing for people to understand is that's okay, right?
Mhm.
You can make that decision, right? As long as you're making it as an informed decision and you understand the risks that you're taking.
The flip side of that in the rewarding fighting style is putting money into companies you think are doing the right thing. But how do investors distinguish between greenwashing and substantive change? And what kinds of resources do you consult when you're thinking about those questions?
It's something that we're getting a lot better at because the reporting is getting a lot better, right? 5 years ago, there was, hardly any companies were doing sustainability reports. Today, just about every Fortune 500 company does a sustainability report. Um, and there are international standards that are out there that are not required, right? But they have gotten enough reputational heft that these companies will do a good job of at least trying to meet those standards, right? So it's gotten a lot more robust. It is far from perfect, but it
Mhm.
is a lot better than it was 5 years ago. However, if you are an average investor, the last thing I would suggest you do is go download a 300-page PDF of a sustainability report and try and look at the 8-point font and figure out what's good and what's
It's
bad.
not written for them. It's written
No,
for the regulator and it's written for the fund manager who has the
correct.
resources to tease this information apart. And I've been on that side of the conversation. Translating it into something that an individual investor can use is not the priority for any of those companies at this time. So, what kinds of tools do you use? You point to one in the article, the MCSI ESG ratings and climate search tool. Tell us about how you use that.
So what I like about this tool, so MSCI is a ratings agency.
Mhm.
And so they provide now, over the last couple of years, they've started providing ESG ratings, right?
Mhm.
And so you can pick a company and search it in there, and they will tell you their opinion of this company, right? Again, it is their opinion, but it's a good sense check. They're independent, right? They've got those people who were looking at page 175 of the PDF, right, and incorporating that data and making a judgment call about it. Is it the gospel? No, but it's a good way to say, oh, so if I'm looking at Amazon, they're good at sustainable packaging, but they're not so good with labor practices, right?
Sure.
Or whatever it might be. And that's a good way to sort of sense check what you might be thinking about a company. Um, but my real answer for this, though, is that I don't want to be thinking at the company level. I want to be thinking at the fund level. I want
Mhm.
to find the fund managers, like you said, who are spending the time looking at those huge PDFs, making those decisions, thinking about what's best, and making that really informed decision, right? in over the last 20 years, the big move has been really to passive, super cheap funds. Don't even
Mhm.
think about it. Give me the whole market and take all the thinking out of it and give me the lowest fee. But with this sort of investing, this sort of thinking, there is value in having somebody with a finger on the button who
Yeah.
can look at these reports and say, okay, we're going to make an investment decision based on the reporting that's coming out of here, based on the values that we know that our clients have regarding this issue.
Well, and that active management, I think, is really important in an intensely evolutionary market because you do
Yes.
need that kind of expert guidance. On the
Yes.
other hand, you need to rebalance your investments. How would you, on a regular basis, how would you counsel someone to assess their fund manager's performance beyond simply, did I get the highest return?
So you want to look at those reports. Those big long reports you get in the mail that you throw away from your fund manager every year. This time you can look at it, right? Look in there and see what they're saying about what happened this year. Why
Mhm.
did they make an investment in company X? Did it have anything to do with sustainability? Right? Why did they lose money in this sector? Was there some sort of sustainable reason that they were in there? Right? These investment commentaries, and most of these companies put them out on a quarterly basis, right? That's where you can go in and you can read. A lot of these fund managers will also put out, they're often called different things, but they'll often call them impact reports, right? Well, they'll go and they'll say, here are all the companies that we met with this year. Here are the things that we got them to do. Here's the changes that we made. Here's, the progress that we've done, right? When we talk about that engaging fighting style, they're going to tell you about those engagements. They're going to tell you all of the votes they made at all the different shareholder meetings, right? So when you get into this kind of investing, it's it's okay to be excited about it, right?
Yeah.
It's okay to say, hey, this is kind of cool. I don't want just, a number. I want to know what else is going on. And that's part of the fun.
Well, and I think you're also pointing to one of the other changes that's happened over the past 30 years in investing is it has become partly a sport. It's an
Mhm.
engaging thing to do when you understand what you are doing and you're not losing a lot of money.
Correct. Correct.
But there are
And
the
doing
other
it with
side
your
of the market
values
is
in
there's
mind makes it all the better, right?
well, now the engaging style, the fighting style, is sort
Hmm.
of rewarding plus activism. And
Hmm.
and so far, a lot of people believe that the individual investor doesn't really make a difference. What's your take on the power of one proxy vote?
I think it's very similar to the way that you think about your participation in elections,
Mhm.
right? No, it is probably not very likely that your one individual vote in the presidential election is going to tip the scales, but you still do it. It's part of your civic duty, right?
Sure.
When you are an owner of a company, it is your business duty to participate in that shareholder vote, in that proxy vote. And the way that you can do it effectively is aligning your money with fund managers who are going to push for your values, right?
Mhm.
You're saying, I'm going to put my money with asset manager X because I like the way that they vote, right? And that is how I am amplifying my vote and amplifying their vote, right? This is real. It's like the party system, right? You're aligning with the people who are pushing for the change that you believe in, right? So no, I'm not going to tell you that the 0.0001% of Pepsi that you own is going to change how they use aluminum cans, right? But
But there are moments like the Exxon proxy vote where they moved two board members off the board with an organized effort. So that's the other question I wanted to ask about engaging is how do you connect with other investors or at least find out what they're doing and align with it so that you can have an amplified impact? What tools do you use?
well, let me go back to the Exxon thing for a second, because one of my favorite statistics out there is that if you owned about $200 worth of Exxon stock and you voted, or you had that with the manager who voted, you had the same amount of impact as you had in the 2020 presidential election, right? So when you think about the amount of time and energy and thought you put into the presidential election versus the amount of time and energy and thought you put into the shareholder vote at Exxon, it's just interesting to think about, right? That the weight is so different. So getting back to your question about how do you align, or how do you do that? So in particular, a lot of these specialty providers, right? So we've
Right.
talked about like BlackRock and Vanguard, and there's plenty of them. But there are also a lot of specialty providers, right? Some of the biggest ones are Parnassus, Calvert, Domini is a very famous one. You can learn all about them in my shamelessly plugged book at the back there. But there are always working groups. There are always initiatives going on, and you will see these companies pop up in these initiatives, right? So like Vanguard very famously backed out of a net zero investment initiative. I think it was last year. But
Mhm.
these specialty companies are in there and they're working on how do we invest in a way that encourages us to get to net zero, right? So looking at those sort of working groups and NGOs and things like that. Another good place to look is, the U.S. version of SIF. It's called the U.S. Sustainable Investment Forum. A
Mhm.
lot of these companies participate in that as well. That's a great place to go to learn about them as well. So they're out there. They are to be found. You just need to do a little bit of looking.
Yeah, and the other one you mentioned in the article that I think was really valuable is the Manhattan Institute's proxy monitor.
Yes. Yes,
Now,
that's a great one. So you can go in there and you can look at all the different proxy votes that have put up, and more importantly, you can see who put them up, right?
right.
Who did that? And there are some asset managers in there, right? Some of the ones we talked about, the Dominies, et cetera, that you can go in and say, oh, you know what? I really like that these guys were pushing for issue X at company Y, right? And therefore, I'm going to take a look at those funds because maybe this is a group I really want to align myself with.
Ben, this has been a great conversation. Let me ask just a couple of closing questions. What
Sure.
news sources do you tend to follow in order to understand your ESG investments?
So it's a very difficult question. And your question earlier about how there's so much rhetoric
Yeah.
is very true and very very top of mind when I was thinking about this. And so my answer is the as down the middle ones as you can get, right? Opinion pieces are just that. There's a lot of scaremongering on both sides here,
Mhm.
right? Over the summer when the conservatives were up in arms about this, there was a lot of this scaremongering going on. So rather than recommending a specific source, I'm going to recommend a type of article. And the
Okay.
type of article is the bigger picture articles, right? The bigger, the better. The ones that are looking at, what are some of the big policy ramifications going on? What are some of the projections over the next 10, 20 years, right? Those are the ones that I think are most important. The ones that say, well, how did ESG funds do last quarter are not as important, right? So you want to look for news and insights that are really big picture, large trends, and not worry about the quarter to quarter or even the day to day, right? This is not a game for day traders. This is a
Exactly.
long-term game.
Right. And a buy and hold investor needs to make a confident choice and then live with the choice for a while rather than start backing out. You'll lose a lot of money that way. But
100%.
you drew the analogy of the party system a few moments ago in politics, and
Hmm.
we really have come to this point where it's like, well, get on one side or the other. But your point about the middle is where the real trade-offs and the real change and debate and discussion and transition begins to happen.
Hmm.
uh, when you think about where we're going to be in 5 or 10 years from now, can you say with confidence at this point that you think we will have an environmentally, socially, and governance responsible economic system?
Boy, that's a tough question, right? I certainly hope so. I
Right.
certainly hope that's where we're headed. But there are lots of things that might happen in November of this year that will be a
Yes.
real hindrance to that happening, right? I think, and you've also got to think about it from a global perspective, right? So in general, the EU is a little bit more advanced on this sort of stuff than we are, but China and Russia and Middle East, this is a global phenomenon. What I think is, unless something goes really sideways, we will be better at this in 5 and 10 years than we are now.
Mhm.
Is it good? That's in the eye of the beholder. But I do think The regulations are going to keep coming. I do think the standards are going to keep advancing and getting better. I think we're going to get better at analyzing this. We're going to get better at talking about it. We're going to get better at explaining ESG from an investment perspective and not just from a values perspective. Whether that tips the scales against people who are interested in seeing this not succeed, that I can't tell you. But I think we're making progress.
And progress is going to be something that is distributed and mixed rather than easily defined and that you can point at and say, that's the change I wanted. It's
Yes.
a whole lot of changes, as you just said. It's a global process that we're going through.
Yes, and there will be wins and there will be losses, but that's all the more reason for you as an individual to vote with your dollars and invest in the companies and the fund managers who are pushing this forward.
So as they try to follow the progress in the market, how can folks follow what you are doing at Till Investors?
So you can hit us at tillinvestors.com. You can sign up for our newsletter. We put it out every month, and it's light. It's not meant to be a deep dive, right? We want to keep you in the know, but it's not homework. You can also there find a link to our book, Sustainable Investing, an ESG Starter Kit for Everyday Investors. It is, again, a light read. It is meant to be a light read. Spend an hour or two with it. You'll feel much more confident in your ability to make a sustainable investment decision. And then also you'll find us on LinkedIn and Twitter and all the good places. We're not shy.
Well, Ben, thanks for spending time with us today. It's been a fascinating conversation.
Thanks so much, Mitch. It's been great.
That was my conversation with Ben Vivari, co-founder of Till Investors. You can sign up for Ben's newsletter at tillinvestors.com. Till Investors, all one word, no space, no dash. And Till is spelled with two L's. And you can also find links to their book, Sustainable Investing, an ESG Starter Kit for Everyday Investors. It's available at Amazon and barnesandnoble.com, amongst other locations on the net. You know, markets like national political campaigns or conversations, and 2024 will be one of the most important years, if not the most important year, in investing and policymaking during our lifetimes. The hyperbole swirling around ESG investing is part of a contest to win our hearts and minds over to one of two approaches to progress. The anti-ESG contingent argues that we should stand pat, preserving the energy infrastructure we have, despite all the evidence that fossil fuels and extractive business practices are bad for our health, for the environment, and for future generations. ESG investing advocates are asking for us to recognize that the unaccounted costs of today's actions for future business performance, as well as the social and geopolitical costs of the take, make, waste approach to living for our children and grandchildren, are something that we must pay attention to and prevent changing their world without them having the voice that we currently have when we make a decision to invest or to buy something that's made sustainably and responsibly. But you know, today's energy infrastructure hasn't been here for very long, only about 250 years. It's just one of many that we have used as a society over time. The energy infrastructure and extraction-based economic models that we have today are just one of many approaches that humans have relied on, and history shows us that transitions can create wealth and improvements in humans' life. Your choice as an investor to choose responsibility for the future in addition to short-term profits can make a difference. So you should learn about your potential power and exercise it, as Ben explained. And of course, we'll continue to talk about ESG here on the show. And I hope you'll take a moment to share this podcast or any of the more than 440 interviews we produced on sustainability in your ear with your friends, your family, your coworkers. Please stop people on the street and talk to them about what you think the world needs to be like. Don't be pushy, just be polite. Writing a review on your favorite podcast platform will also help your neighbors find us. And folks, you're the amplifiers that help spread more ideas so that we create less waste. Please tell your friends, your family, everyone you meet that you can find sustainability in your ear on Apple Podcasts, Spotify, iHeartRadio, Audible, or any of the other fine purveyors of podcast goodness they enjoy. Thanks so much for your support. I'm Mitch Ratcliffe. This is Sustainability in Your Ear, and we'll be back with another innovator interview soon. In the meantime, folks, take care of yourself, take care of one another, and let's all take care of this beautiful planet of ours. Have a green day.